I guess as people come in, I'll just add them in. So just to briefly introduce ourselves, my name is Steven Pitucci. Joining me is Neal Winokur. We are both partners of RealtyTax.ca, which is the all-in-one tax solution for Ontario real estate agents. So our main client base right now is real estate agents in Ontario. We're assisting self-employed realtors along with realtors who have personal real estate corporations. So basically all the bookkeeping, the accounting, the taxes, we manage all of that for our clients. We started back in October. So far, things have been pretty positive, and it shows also in the response we've been getting from our realtors. So check out our website. There's a lot of reviews there. And also for people joining us, I'm sure you probably found us on the Facebook group Tax Tips for Real Estate Agents. So that's a really good place to check out weekly tax articles or tax updates, or if someone's posing a tax question like one did today, which I'll answer in the chat today. It's a great resource to check out. So with that all being said, Neal, do you want to start it off? And I guess the way how we'll do this is that we'll start off with the topic, and then other people who have questions, they can simply raise the question afterwards, and then we can have a discussion.
Sure. Yeah. Thanks, Steven. Yeah. So what I wanted to do just for the first part of this is actually just convey a few what I think are the most important critical tax tips for realtors. Okay, so if people have questions, feel free to type them into the chat. We will also have time at the end for Q&A. We're going to leave a lot of time for just open Q&A if people have questions.
Oh, sorry. Just one other thing, Neal, before you start, just want to give just a brief disclaimer. Of course, all the information we're giving is just informational and may not apply specifically to your situation. So, of course, we always recommend if you feel something does apply to you, reach out to us. We'll be happy to do a free consultation. I just want to put that out there. Because I know this is going to be distributed, so just want to cover ourselves. Anyway.
Okay. Yeah. Okay. Thank you. So, number one, this is so important, and it actually applies to all self-employed people, not just realtors, but it's also extremely relevant for realtors. What we urge all of our clients to do is to set aside the HST that you collect. So commission income plus HST comes into your bank account, whether by check, direct deposit, whatever, and it's sitting there. So let's say you collect a commission for $10,000, and 13% of that is, what is it, $1,300 or something?
Mm-hmm.
Yeah. So let's say, so you really collected $11,300. Remember that $11,300 includes $1,300 of HST. So we tell all our clients to do, when you open a business bank account, whether you're sole proprietor, whether you're incorporated with the PREC, same thing, doesn't matter. Open a savings account. So you have checking account, savings account. Doesn't cost you anything extra to tell the bank to open that savings account. And what you do is every time a commission check comes in, take that HST portion and just transfer it into the savings account. It's so important because you have to pay that eventually to the government. Remember, the government is forcing you to be a tax collector. You are a tax collector for the government. They're not paying you for this wonderful privilege, so you're doing it for free. But that's the law. Unfortunately, you have to do it. And I actually talk about this in my book, The Grumpy Accountant, which is available on Amazon.ca and Indigo.ca, and the ebook and audiobook are available everywhere. But definitely we tell every single one of our clients, open that savings account and transfer, whenever you collect HST, just transfer it into the savings account. Now, some people say, well, when I file my HST return, I don't have to pay all of that HST to the government because I have expenses and I pay HST on my expenses. So that's true. So maybe you just want to set aside, I don't know, 75% of it or 80% or 90%. You could come up with an estimate that works for you. That's fine. We help our clients do those kinds of estimates. But as long as you're setting aside something, you're in a good spot. So that's very important. Yeah. And the other thing I would mention, aside from HST that you have to pay, remember, you have to pay income tax at the end of the year now, or in installments throughout the year, right? So, and that again, that implies to whether you're sole proprietor, whether you're incorporated with the PREC. So a lot of our clients ask us to, because we also tell our clients, set aside an estimate of income tax that you might owe at the end of the year, or if you're paying installments throughout the year, you have to set some aside. So how do you know how much to set aside? Let's go back to that original example where I said you collected a commission for $10,000 plus HST of 1,300. If you set aside the whole 1,300 for HST, the next question is, out of your $10,000 of revenue, how much of that should you set aside for income tax? Should you set aside 5%, 10%, 20%, 50%? That will depend on the tax bracket that you're in. That will depend on whether you're incorporated in the PREC with a 12.2% tax rate, right? So that will really depend on your situation. What I want to do now is actually share my screen. Let's see if I can do this. Share. Can everyone see my screen? Yeah. Okay. So this is my favorite tax calculator. Okay. If you go to Google and type in EY, that's Ernst & Young, our wonderful friends at Ernst & Young, EY tax calculator, you get to this website. And what I would tell you, and then you go here where it says, hold on, there. So Canadian personal tax rates, okay, 2021. You go down to Ontario or whatever province you're in, but I assume everyone here, most people are Ontario here. So you go to Ontario, and here it shows you the tax rates for each bracket you're in. So actually what I wanted to show you was here, personal tax calculator. Here we go. Click on 2021. Now this is a very nice little tool here. So here's Ontario. Okay. So what you do is you taxable income. So what you have to do is estimate, okay, what's your revenue for the year? Let's say it's $100,000. And then obviously you have expenses that reduces the revenue, right? Expenses are offset. They offset the income. So let's say you have $25,000 of expenses. So your taxable income will be $75,000. Click calculate, go down to Ontario. Here's how much you will owe in income tax, $15,000. So now you know how much you have to set aside for the year. You'll also have to set aside Canada Pension Plan payments, CPP, right? I just want to stop sharing my screen. Here we go. Stop share. So you have to set aside that amount of income tax. So that's a very helpful tax calculator. You can go to there, go to that tax calculator, type in your income. You see how much income tax payable you have. You'll have to do an estimate of how much Canada Pension Plan you'll have. So right now it's about the maximum. If you hit the maximum CPP earnings, you'll owe about 3,100 times 2 of CPP. This is if you're a sole proprietor. So you'd have to set aside an additional $6,200 approximately of Canada Pension Plan, plus that $15,000 of income tax. So we help our clients do these kinds of calculations. Now, if you're incorporated with the PREC, this will be a whole different calculation, but the general idea is the same. The main point here, the main tip that we're trying to get across is you want to set aside the HST, set aside an amount for income tax. And that way at the end of the year, or when you're paying installments, you have it already set aside. It's not negatively impacting or affecting your cash flow because you're ahead of the game here and you've dealt with it. So this, I think, it's probably the most important tip, because people who don't do this, at the end of the year, all of a sudden they have a $50,000 tax bill and $25,000 HST bill, and then they fall behind, and the next 5 years they're catching up. It's very stressful. It's very frustrating.
Yeah.
And you pay interest and penalties. Yeah.
And just to add to what Neal's saying, with the clients that we've dealt with so far, the biggest issue seems to be not only the income tax, but especially the HST falling behind. Where I think part of the issue lies is again, like you kind of get the money at first and you think, okay, like it's your money, you can spend it. No, it's actually trust money. It's really government money that you need to be setting aside. Sometimes too, what we find with realtors is that they're not even aware, saying how much of the money that they received is really HST. And of course, the brokers should be giving you a breakdown to say, this is how much is HST, this is what is in there. But even if they don't, take whatever you got from commissions and take off 13% of that, and then set that aside into HST. When it comes to CRA as well, when you owe income tax and HST, they typically go after HST first. And they are quite aggressive with it. If you fall a couple quarters behind, they're going to start saying, okay, we're going to get you in touch with collections. And you don't really want to hear those words, because usually it's like setting up like a payment plan that's, may not be in your favor. So we always tell clients saying, to avoid that issue, make sure as you're earning the money you set it aside to pay off the tax debt. Paying off tax debt helps you in various areas of your life. It's not just in, when it comes to reducing interest and penalties. It helps you if you're getting a mortgage and a whole bunch of other things. So just want to throw that out there. Okay. Just gonna add a few more people to the room. Okay.
All right. So, okay. So the first tip was set aside HST, set aside income tax. There's helpful tax calculators online that you could do an estimate of what you should be setting aside. And we help all our clients do this. And we advise them specifically what amounts we want them to set aside. Now, another tip. Yeah,
sorry, Neal, just related to what you were just saying as well. One other thing too, it's also the issue with HST is that I don't believe, I have not even seen it personally on my end, because I'm an HST registered and I got to pay HST like the rest of you. But the thing that I noticed is that CRA is not very good at giving installment notices. So if you owe over $3,000 of HST, it's up to you to figure out saying, oh, I got to pay a quarter of what I owed last year in installments. Like if you typically do pay installments and you're probably used to it, fine. But I find it's not a very good system where basically you're expected to pay installments. You get no notice about it. The only time you find out is when you get like a notice, like an assessment saying, by the way, you owe X amount of installment interest. People get upset. They're like, well, how could I have avoided this? You got to be proactive about it. Our system isn't there to tell you everything that you need to do, unfortunately. Obviously, we're here, but the government isn't. So, so just wanted to put that out there as well.
Okay, so another tip, one of the most common questions we receive is from realtors specifically, is what expenses can you claim as a realtor? You know that every dollar of expense that you claim reduces your income on your tax return and therefore reduces your tax payable, reduces your tax bill. So it's very important to claim every single dollar of expense that you are legally entitled to. You are fully allowed to within the rules of our tax system. So this is such a common question. And there's a lot of like gray area confusion. So I'm just going to share my screen again because we have a very helpful resource I want to show everyone. So can everyone see my screen?
I see the Seinfeld background, but yeah.
Oh, can you see the screen now?
Yeah.
The website? Okay,
yeah.
So if you go onto this is our website, RealtyTax.ca. And if you scroll down, we have a downloadable free PDF. Where is it here? Here, right here. Download your free guide to deductible expenses for realtors. Download. And when you open this up, it's a 3-page PDF. And this literally shows what this is for sole proprietors or incorporated with a PREC. Okay. Basically, this shows every expense you're entitled to claim. So I would encourage everyone to download this, take a look. And this should really answer all your questions. So we often send this to people who ask us, oh, what expenses can I claim? So you have advertising and meals, entertainment, and your insurance, interest and bank charges, license and memberships, office expenses, your professional fees. It's all here. Office rent, right? Repairs, maintenance, salaries, wages, benefits, travel, vehicle, telephone, internet, capital equipment, home office. So it's all there. It's a very helpful tool. So definitely recommend people check that out. If you have any confusion about what expenses can you claim, what expenses can you not claim, that's a very helpful tool that we have, which should give more clarity.
Yeah, and actually related to what Neal's saying too, another common question we get is not only the expenses can we claim, but they wonder saying, if I set up a corporation, can I claim more expenses compared to as a sole proprietor? When it comes to those expenses, there really is no difference at all if you are incorporated versus if you have a sole proprietorship. So the intent of setting up the corporation should be more for tax deferral purposes, which depends on more of how much money do you need from what you earn, not so much about saying, oh, okay, I want to claim more expenses, let's set up a corporation. It has nothing to do with that. If you read stuff online that says that, again, it's incorrect, or at least maybe it's from some other country, God knows. But I mean, I'm just saying that don't really, it's the same whether you're a sole proprietor or you're incorporated. Okay.
Yeah. So, and just another tip before we maybe go to Q&A, another tip would be, obviously, when you claim expenses, you have to keep supporting documents to prove these expenses. Should the CRA ever ask in some sort of audit or review of your expenses, you have to prove it. And one of the, we get this question often. If I pay for the expenses with my credit card, is the credit card statement itself sufficient documentation and proof for CRA audit purposes? The answer is no. The CRA, if you send them the credit card statements without any receipts, they'll throw it in the garbage. They'll return it to you. They'll mail it back to you. And they'll say, look how nice we are. We're mailing back your documents to you. They don't accept they don't accept the credit card statement as proof of the expense.
Yeah.
Why? Who knows? It doesn't prove HST. Maybe it doesn't prove this. It doesn't prove that. You really have to keep the full receipt. So what we do for all our clients is we set them up. We have different software and apps that we like to use, and we use QuickBooks Online, and we use an app called Dext, D-E-X-T. We used to be called Receipt Bank. And we take care of all of this for our clients. But if you're trying to do this yourself, if you're, whether you're sole proprietor incorporated and you're trying to do your own bookkeeping and your own record keeping, we definitely recommend people try to move away from what I call the 1985. I was born in 1985. So the bookkeeping method from 1985 was, you keep a shoebox of receipts throughout the whole year. And at the end of the year, you spend a week or a day or 3 days or 5 days or 2 weeks, and you take every single receipt and you sit there manually inputting it into an Excel spreadsheet. This is insanity. We have to move away from this method. It's funny, when I go to my daughter's pediatrician's office and I look, they have the file room, and there's like walls of just paper folders and files. And I don't understand. This is 2021. I feel like I've gone back in time. This is how a doctor's office looked 70 years ago. It hasn't changed. But in accounting and bookkeeping, there's so many tools now that can help you and really make things much more efficient and clean. And you don't need to keep paper copies of receipts. The CRA accepts scanned copies as long as they're legible. And the apps we use with our clients are like CRA audit proof. So this tax tip basically is, you can check out for yourself. There's QuickBooks Online. You could sign up, do a 30-day free trial, see if you like it. And there's apps you could download on your phone even that help you scan in receipts. There's a million different apps out there. We have particular ones that we use for our clients. But just kind of starting to think about this and think about transitioning away from a very old school, old fashioned style of bookkeeping and record keeping to really, because what it does is it saves you a lot of time and it saves you a lot of heartache, and you can keep everything scanned in nice and clean. And then you're ready to go at tax time. Everything's scanned in. If you have an accountant or whether you do it yourself, everything's ready and organized. And then you're not going to file late. A lot of people file their tax returns late because they're spending so much time going through all the receipts. They procrastinate throughout the whole year. So what we do our bookkeeping for our clients every month, updated monthly, it's done. So at the end of the year, we're ready to go. We're ready to start preparing the year-end tax returns, whether sole proprietor, whether incorporated. Either way, we want to meet those tax filing deadlines so we don't incur penalties and interest. So what I would encourage everyone to look into these methods and stop using bookkeeping methods from 35 years ago.
I saw Chip, you're raising your hand there.
These days, almost everyone sends an electronic invoice. Like I just got, the receipt from you guys. I have a folder, one for each year. Underneath that folder, I've got a subfolder Realty Tax, and I put it in there, July, receipt or July invoice, my videographer, so that, there may be some paper receipts for other things like gas or whatever, but at least the majority of them, they've emailed them to me, and as I go along, I just add them to these folders so that they're there.
Yeah, Chip, that's a great point. And especially, I think that's kind of the issue in the past, is that why did people keep paper receipts of stuff? Because they knew that their suppliers or vendors, they'd only give them paper. Even before Realty Tax, I was dealing with another client who's in construction, and about a quarter of the suppliers give paper, 3/4 do electronic. And I told them, saying, look, even if a quarter is still doing paper, the fact that you have electronic is really going to help you out, because, like in your system, if you're saving into a certain folder, that's fine. For other setups we've done with other clients as well, is that we have that information get published right to Dext. So what that is, say you get the email come in, instead of even saving it in a folder, you can forward it to Dext, and then it's already in our accounting software. And again, so some people use Dext, some people don't. That's totally fine. But I'm just saying that that's another alternative. It's definitely a benefit to having stuff there. Another thing too that we gotta remember is that we have to consider like the chemistry behind the receipt, and that in time receipts fade. If CRA wants to see things for previous 3 years, sometimes like I remember like Costco receipts used to be notorious for this, where you get a receipt and like a week later it's faded and I can't even read the thing, and I have something it's a month old I want to return, I can't return it. So anyway, but luckily they always have a record with Costco. I learned that. But anyway, because crappy receipt systems. But again, like this could be not just Costco, it could be anything else too, where if they fade, God forbid your office catches fire and you lose all your documents, like I mean CRA won't care. So digital copy is totally fine. It's basically buying insurance for yourself and for your taxes.
Okay. So just to summarize for those who came, the first tip we discussed today was setting aside the HST that you collect and setting aside an additional amount for income tax that you owe at the end of the year. And there are helpful calculators online that you could do that help you with that. And we do that for all our clients. And then the next tip we discussed was what expenses can you claim? And if you go to RealtyTax.ca, our website, there's a free download. You just scroll down a bit. There's a free PDF you can download. It's 2-3 pages. It shows every single expense. And the third tip we just discussed was about keeping receipts, and that we shouldn't be using bookkeeping and receipt keeping methods from 30-40 years ago. We have updated methods now, lots of online, really good cloud-based, apps, technology, and we encourage people to check those out. And the last thing I just want to discuss are PRECs, personal real estate corporations. And Steven will talk about this also. But if you have already incorporated your PREC, that's great. If you haven't, you may or may not need to, right? Every person has a different situation, different level of income, different needs for the personal budgeting. This is the most common question we're getting now. Should I incorporate or not? And what we tell people is it depends on your situation, okay? For if you're in the highest tax bracket, personally, like if you're over, 200,000 income or even over 150,000 income every year, probably you should incorporate. Probably, most likely, yes. If you're under 150,000 of income, maybe you still should, maybe you shouldn't. It really just depends on the situation. So what we encourage everyone to do is schedule a free consultation with us, and you could email us Neal@RealtyTax.ca or Steven@RealtyTax.ca. I'm just going to put our emails here. Or you could do info@RealtyTax.ca. And we do free consultations where we get to know your personal specific situation. We want to know your level of income. We want to know if you're married or living common law. Do you have children? What are your personal living budgeting needs? How much money do you need from your corporation every year for your personal income needs? Because if you need $0, let's say you won the lottery and you're living off lottery winnings, and all your commission income can be going to your personal real estate corporation, there would be a great advantage to that, right? So, or maybe you need all the money from your personal real estate corporation every year for personal use. And then really there might not be such a big advantage to having the corporation, because if you're pulling all the money out every year, you have to pay the personal tax anyways. So it really, really depends on your situation. We need to look at TFSA, RRSP, RESP. Do you already own your principal residence or not? Because if you don't, and you're going to pull all your money out from the PREC because you need to pay a down payment on the principal residence, well, then it's all personal income anyways. So maybe we don't need the PREC. So there's a lot that goes into this decision. It's not just a yes or no, or it's not just like everyone thinks it's like, once you hit this level of income, you incorporate. If you're below that level of income, you don't need to. It's not true. That's a myth. You got to look at your situation. So we do those free consultations for everyone. You could go to our website, and there's a contact form where you could reach out to us, or you can email us. I put the emails in the chat.
There's one point I want to make on what Neal said, but before I get into that, I want to also raise the floor for any questions that people are waiting to ask us. And we also have the chat that you can use in case you don't want to speak or your microphone's not working. Okay, I guess while we're waiting for some questions,
I have one.
Oh, sure, go ahead.
Client gifts. I'm involved in a bunch of real estate groups that are from the States, and I know the rules are different there. Are all client gifts deductible here, or do they have to have my name on them? Like, it could be an advertising piece, Like if I send flowers to a client or, you know, buy them a tray with nice glasses with the bottle of wine, are they all deductible?
Well, basically, when it comes to client gifts, we have to look at the nature of the gift. If it's more like what we consider meals and entertainment, so what that basically is and sometimes people say it's not that, it's just really just like a form of advertising. Then normally the answer is yes, it would be deductible. What we've seen just from previous situations with CRA and them looking into this stuff, to the most extent, obviously they'll need to see the supporting receipt. So that's what we were just talking about earlier.
Right.
What they also would want to know sometimes is who you actually had, like who that gift was for, or the nature of that gift. So that could come about in an audit where they may ask those further questions. Sometimes if it's like, even let's say if it comes to, let's say like a meals and entertainment expense, they may ask questions to say, which client specifically did you bring out
Yeah.
to that, right? Because of course, when you go spend something, you're not going to, it doesn't know, like the person's name is not going to appear. Let's just say you go to like the keg and it doesn't say, oh, Jack and Jill had dinner together. It would just say your name or whatever name's on your credit card. And that's
I
it.
normally write it on the receipt, you know, dinner with Peter Bryden.
Yeah, that's some things where they could hone in on to say that now, like for example, if by default you don't have it on the receipt, they could inquire about that later. I would usually say even if you keep, let's say, like a separate log to say of those receipts who it was for, that should be sufficient enough, and you can support that with those receipts that you give in the event of an audit.
Yeah, I keep an Excel spreadsheet with notes just for that very reason.
Yeah,
But most of the time, when I'm talking about closing gifts, like I give them a nice loose-tight tray with glasses and a bottle of wine. That's my standard go-to.
Yeah,
So,
that is a cost of doing business. That's one thing we just
yeah.
got to keep in mind
Okay.
anytime we're claiming any expense here.
Right.
So you brought up a good example about advertising and
Okay.
client gifts, but if you are incurring an expense in the course of running a business, that's directly related to that business, and it's what we consider a reasonable amount. So if you're trying to find like a random write-off and you give, let's say, $10,000 worth of tickets to Leafs games for clients, and you've never done this before, CRA could say, that's a bit unreasonable, right? Even if it is incurred as a business, technically a business expense. So that's why we got to look at what is reasonable or not. But as long as it was incurred for business activities, that should be deductible. And the HST on that should also be claimable if you're registered for HST.
So along these lines, there was an article a couple of weeks ago in the Financial Post by Jamie Gollenbeck. I want to share my screen because this is exactly this question. How do you define what's a business expense? Can everyone see my screen? Okay. Can a wedding be written off as a business expense? Okay. So some guy tried to write off the entire wedding for his daughter. Okay, this is the article. You guys, you know what? I'll put the link in the chat. And it went to the tax court, and basically the answer was no. But it went all the way up, like they appealed it. It went all the way to the highest tax court of Canada, and they basically tried to hold on, I think I sent it. Here we go. There, the link is in the chat if you want. It's a very funny article to read, because what they tried to prove was the people in attendance at the wedding were all of the business associates of the host of the wedding. So he said, yes, it was my daughter's wedding, which is obviously personal nature, but he had his business associates there. And then the question that the judge had to answer was, were they discussing business? Was the purpose of the event to discuss business? And clearly it wasn't. But
I was going to say that would be a pretty sad wedding for the daughter if they're all discussing business.
Yeah.
Anyway.
So you do have to obviously be careful here. And there's sometimes there's gray area. And one of the things we help our clients with, things like, you know, the home office expense. Well, what percentage should you be claiming, you know, based on the square footage of the office in your home versus the entire home, right? So we got to be careful here. Same thing with car expenses. Like we tell people, don't try and claim 100% of your vehicle expenses, because you'll be risking a CRA audit. The CRA will say, really, like 100% is drive business use? Like you never drive to the grocery store, like you don't drive, I don't know, to your kids to school or something. So it could be that there's obviously personal use in some of these things. So you just want to be careful. We've seen people, they try to claim every single grocery bill as a meals and entertainment expense. Like don't try and do that kind of stuff, because you're just going to cause problems for yourself. So this is something obviously we help our clients with when there are those gray areas, right? How do we navigate that?
Yeah. And also, since we're talking about claiming expenses, we always say to avoid having the CRA look into your personal affairs, because this is one thing that a lot of realtors do, even especially unincorporated realtors, is that they throw all their expenses on one credit card, right? And in that, I mean, not to say that they're claiming everything on the credit card, but the issue there is that if CRA does an audit and they're saying, okay, we want to show proof, like we want supporting receipts along with proof of payment showing the actual credit card statement, while there may be some things you're spending on your credit card, you may be a bit uncomfortable having the CRA look at, right? So what we usually recommend is, well, for corporate clients, this is a must, but even for unincorporated realtors, it's really good to have a separate credit card just for business, right? So what that means is that any expense that you have, whether you like different, I know it's unfortunate, it's another piece of plastic you have to keep in your wallet, but you know, if you use a card only for business, the good thing is that it helps you track things better. You know, let's just say if you're doing your own accounting. But the other thing too is that if you were to get audited, you can just tell the CRA saying, look, this is only what I use for business. And most likely they're not going to want to delve into your personal credit card accounts. Okay. So this is something I really want to mention. Another thing too, I just want to get into, and of course, if anyone has a question right now, feel free to stop me, but otherwise I'm just gonna continue chatting, was what Neal was talking about before about personal real estate corporations. And when people say, I'm not sure when to do it, or well, when should I do it? And as Neal was saying, it's not really based on level of income. It really depends on your needs. One thing that I also want to stress, which is a common reason why people are kind of being hesitant on setting up a personal real estate corporation for themselves right now, is they're concerned saying if the market has a downturn in the foreseeable future, maybe this was a waste of time setting up. I actually think there's a lot of I definitely have to disagree with that mentality. And the reason why, it's not because I have self-interest and I'm just saying, well, I'll buy it anyway. The reason why I say this is that let's just say we're in a good year right now, right? Especially in GTA, you know, market's hot, properties are selling for top dollar. So realtors are making a lot of money. I mean, just overall, right? So we'd say the average realtor is in a good year. Now, let's say you set up your PREC today, right? For the rest of between August to December, your commissions can go into your personal real estate corporation. Now, let's say we look into 2022 and unfortunately the market starts to downturn a bit. Not that I'm expecting a big downturn, but yeah, some things, prices may go down. You may not have as good of a year compared to 2021. Does this mean now saying your personal real estate corporation was a waste of time? You shouldn't have done it? Absolutely not. Because the benefit of this is that with the money that you saved now in your personal real estate corporation, you can now draw that money out for your personal needs, right? And when you draw the money out for your personal needs, you will pay personal tax. But because you're in a lower income year, you're not going to pay as much personal tax compared to, let's say, you drawn the money out in your stronger year, right? We have now, like in 2021 was an interesting year for us because we had realtors that were halfway through the year of being self-employed and then they set up a personal real estate corporation. So they're already in a high tax bracket. And we would generally buy saying, look, if you can save the money in your PREC, don't draw it out because you're already at a high marginal tax rate, as Neal showed the marginal tax rates before. So one benefit is if the market does downturn, it actually makes a lot more sense to have a personal real estate corp because you can draw the money out for your personal needs and not pay as much tax because it's almost treat it like, for example, as if you had like an RRSP. It's like you make your contributions in your working years. So, you know, you're putting money into your PREC in your working years. And then when you need the money, when your retirement years, or call it like your slow years in this case, you can draw that money out. Okay.
You can also withdraw it as a dividend, correct? And wouldn't that save
That's
you
correct.
tax?
Yeah. Yeah. You can do it as a dividend or as a salary. There's pros and cons to each one. Again, it's something that really depends on the situation, which again, we consult our clients on. But yes, Chip, you are correct. You can do it as a dividend.
And if you've paid a lot less tax in the PREC, there's a lot more money left over for next year if you need it, right?
Exactly.
Yeah.
One other thing too, we got to keep in mind is that it also gives you the ability to reinvest what you have in the PREC. So let's just say with that money left over, some people would say, well, if you want to say increase like your marketing spend the next year, you have the funds now to put it towards marketing spend or buy some assets, right? Some people are also, common thing now is that people are buying insurance policies in the corporation. One thing with that, or a bit of a benefit, is that if you were to get, let's say, a life insurance policy personally, well, if you have the money in your PREC, you have to now draw the money and then get a personal policy. What you can do instead is that if the money's in your PREC already, just buy the policy inside your corporation. That is allowed. There are some restrictions on what's deductible and what's not. I don't want to make this too technical, but basically, yeah, with the money left over, you have the ability to reinvest it into your business. See, there's some chats going on. I'm not sure, Neal, if you're.
Yeah, I was kind of answering. So, Vishal, you might want to reach out to us and we could do like a consultation. We don't charge for it, and you can ask us all these questions. But basically, he's saying if you have leftover funds within the PREC and you want to invest those funds, how is that investment income taxed, right? And that's a great question, because inside the PREC, the real estate commission income is taxed at the very low rate, 12.2%. In Canada, you will never get a lower tax rate than that. The small business corporate tax rate is because of the small business deduction. Your first $500,000 of profit is taxed at 12.2% in the corporation. But investment income, if you invest leftover funds within the corporation and you earn interest income or capital gains or dividend income or rental income, that type of income is taxed differently, because that is not active business income, it's passive income. So interest and rental income are taxed at 50%, 50, and capital gains are taxed at half of that, right? Because half of the gain is tax-free. And dividend income is actually taxed quite favorably, but it's a little complicated. But yes, interest income and rental income would be taxed at the high rates of investment income. And we have ways to reduce that and sort of, work around that, like paying out a salary to yourself. If you don't have any other personal income, then if you don't have other personal income, or you're in the low bracket personally, you'll pay a lower rate than the 50% in the corporation. And rental income, you could claim CCA, capital cost allowance, and that could bring the income down to zero. So there are ways to reduce that rate.
Yeah. And I
have a question. If I have money for my PREC and I opened a PREC direct investing account, so it's an investment account with owned by the PREC. So you're saying any gains in that would be taxed at 50%?
If it's capital gains, it's actually half of its tax, so 25%.
Will be investment, like investments in stocks and things like that. That I don't think that.
Right. So
capital gains.
Well, it's stocks. I mean, if you sell the stock, then that would have capital gains. But if it's earning,
so 25%. Okay.
Yeah, exactly. So half of that will be taxed. The other half will go into what we call a capital dividend account, which you get to draw out basically.
So it's really no different whether it's personal or whether it's PREC money.
Right. I mean,
well, it depends, because if let's say you have zero income personally, and then you have a capital gain, right? That capital gain, let's say your capital gain was $100,000. So the taxable half portion is $50,000. Right. If you have no other income and you have $50,000 of income, you might only pay, I don't know, 11 or 12,000 of tax. You're not going to pay 50% tax on that 50,000.
But it's similar calculation bracket, whether it's PREC or personal.
Yeah, exactly. The capital gain is always half of it is tax-free, half of it is taxable. Of course, rumor has it that there's going to be a federal election on September 20th, and be prepared, because I'm willing to bet that some of the political parties are going to propose to increase the capital gains tax rate inclusion to 75% or even 100%. So watch out for that. But apparently the rumor is there's going to be an election called any time now, and we're going to see all the wacko promises that all these parties make and never keep. But they've always been talking about increasing the capital gains inclusion rate. So right now, half of it's tax-free, half of it's including your income. Of course, politically, that could change any time. So, but for now, that's correct.
Thank you.
Do we have any other questions? Because we want to wrap it up here, but we're open Q&A now. So,
well, I don't know whether I'm the only one that has a PREC. I started mine mid-year, June 1st. So I've kept records in terms of, solo agent, up until June 1st. There are some things that are still on the old credit card that should be transferred over to new credit card. So as long as I just keep track of those expenses, we can figure that out later, correct?
Yeah,
Okay,
absolutely.
okay, good.
Yeah, and I was gonna say, when it comes to that kind of stuff, what we just got to make sure is always, like, again, making sure you have all your support for stuff that was incurred
Right,
when the PREC started.
right.
And again, and this is actually a common question too, is that I think the other day we posted an article on this, was about when you're in that transition period, when can you claim expenses? Like, is it under sole prop or
Mhm.
PREC? Really, the general rule of thumb is that when the day the PREC is incorporated and you have that new agreement with your brokerage saying where the funds are going to be directed to, that really means that point forward, expenses you're incurring those are related to the PREC. Now, sometimes there's situations where, let's say you may have, let's say, like a payable as a sole proprietor, and you paid that off when you set up your PREC. Well, technically, like, based on accrual accounting, that is really now a pre-incorporation expense, because
No, that's
sure
not what
that,
I'm talking about. My
yeah,
June 1st was my date,
yeah,
but I had a personal credit card, and then I opened up a PREC credit card. You
right,
go through
exactly.
with them, right?
So,
So there are a few expenses that are coming through on the personal credit card that I realized, oh, I need to get that transferred over, but it's
yeah,
still deductible by the PREC as long as I keep track of
exactly.
what they
Yeah,
are. Okay, that's fine. I'm
that's
color
totally fine.
coding things that should be in the PREC that are not.
Yeah, and by the way, I only brought that up just in case if some other people kind
Sure.
of were in that situation where,
Yeah,
like, I don't know where's the line in the sand. So,
right.
but yeah, no, that's a good point.
Okay, thank you.
Any other questions? If not, there's actually one question that was raised to our tax tips for real estate agents group. I'd like to address. But of course, if anyone's in the room right now, we can also answer some questions.
What real estate agent group is that, the tax tip
Oh, it's
group
on
you referenced?
Facebook.
Is it?
If you go on Facebook, type in tax tips for real estate agents.
Okay, I may be part of that, I don't know.
I'll check. Actually, I can check. I'll tell you right now.
Uh,
Okay, so I'll start with the question that was raised to
Yeah,
our.
Chip, you joined it 4 months ago.
okay, great. Thank you.
Yeah, you're in.
Okay, so one of the questions that we got asked, I think it was this morning or maybe late last night. I believe it's a realtor. He's asking the question. He's saying, one of my clients is living in his principal residence. So this was paid approximately he paid approximately $2 million a few years ago. Now he is planning to sell half of his property, empty land, for $1.6 million. So he's selling the land. Okay, so the question is, how does the tax system work? Does he need to pay tax on the profit of 600,000, or is it considered as part of the principal residence, so no need to pay tax? This is an interesting question, and I don't fully know the answer to this. This actually is a little more complex than what people think. By default, let's just say, so in this situation, this person has a building, and then adjacent to it is land, right? He's wants to sell the empty land. The question is that part of the principal residence exemption, therefore meaning he doesn't have to pay capital gains tax? What is allowed under principal residence exemption is the structure, the space that the building takes up plus 1/2 hectare of land. So in this case, if the 1/2 hectare of land is what this unit makes up, or this vacant land, then you're okay. If it's in excess of half a hectare, what you got to look at is basically, is that being used for the enjoyment and use of the principal residence, aka the actual structure that the person's living in. If the answer is yes, then that would also be allowed. But my issue with this, though, is that he's just selling the land. So down the road, he's probably going to be selling the building. The issue with the principal residence exemption is that you can only claim one PRE, principal residence exemption, on a property per year. So my concern with this is, let's just say the gain on the building ends up being more of a gain on the vacant land, he may actually be screwing himself over claiming the principal residence exemption on the land, because you can only do one per year. And you cannot break it up saying, well, I only sold the land, now I'm going to go sell the building. Basically, I think it's only all or nothing. And again, I have to do some checking on this, so I can't confirm. But just from what I've seen so far, you have to be careful about this. I think, as I said, if it's within that half hectare, you would be allowed to claim as a principal residence, but you may be foregoing claiming the principal residence exemption on that building when you ultimately sell that property.
But that's for this year. Like if you sell it 2 or 3, 5 years from now, it wouldn't matter, correct?
Well, the issue here is that he, like, if with this particular individual, right? Let's just say he sold the land this year, right?
Yeah.
So let's just say it's within that half hectare,
Right.
or if it's even just beyond that, he's using it for the use of the property. Okay, fine.
Right.
You claim the principal residence exemption, but what happens when he goes to sell that building now, or the unit that he lives in,
Does it
right?
matter if it's 3, 4, 5 years from now, or you said per year, right? So,
It's per year. So for
yeah.
each year, so basically when you claim the principal residence exemption,
Uh-huh.
you're indicating which years you want it to apply to, right? Because let's say if you own, let's say for simple situation, you own the property only 5 years. Normally what you do is that you would claim full 5 years that that property's principal
Okay.
residence, and you're fine. The issue that I have is that because it was only half the hectare that he sold, I'm not sure if he can go back and also say that when he's selling that other property, he can claim it again. It could be,
Yeah.
it's a bit of a technicality, a bit of a technical issue
Yeah.
here. That's
I would
why I
tell
don't want to
that
say for sure.
realtor, I would tell the realtor that they need to get accounting advice.
Yeah, exactly.
You
This
know,
is
that's
something
not real
we're
estate, you know, that's accounting.
yeah. No, and this is kind of why
Yeah.
he's asking the group. I don't have any issue with that. It's just
But I mean, it's not, as a realtor, it's not my problem, right? My advice to my client would be, you need to independently get advice from your tax accountant, right? So,
yeah, and this
you
is
know,
actually
it's nice to know, it's an interesting conundrum, but
yeah.
you know, at the end of the day, we have to be very careful what advice we give people.
Yeah, absolutely. And I always tell people, yeah, in these situations, reach out to us or your tax advisor if you have one,
Mhm.
personally, and just to walk them through this stuff, because sometimes too we've also seen situations where sometimes you think, oh, it's a simple answer, and then it's like, oh, but then the person's also a non-resident, and there's like some whole story, and it's like, well, this is not a simple situation anymore, right? Or they're buying it in some holding company, like, well, so yeah, so we always recommend that. Okay. Any other questions? See that the number of people in our group is slowly going down, so I guess we're getting boring.
Yeah, if there's any more questions, you could post it in our Facebook group. You could email us. Yeah.
Okay. So I guess so. I'll wait another minute or two. If not, I guess we'll just conclude. And
I really appreciate you giving the opportunity to have this discussion and open up for questions and answers, because it's information's power. It's always good to have this stuff.
Yeah, for sure. We're happy to help. Okay, I guess I don't see any other questions. So yeah, just to conclude, again, thank you all for joining us today. Neal showing off his book, The Grumpy Accountant there. Feel free to buy that on Amazon. So I mean, I said at the beginning saying I lost the book. That's not true. It's on my night table. I was just too lazy to go get it. But yeah, it's a great book. I read it. Really exposes one of the main big problems in our tax system. It's funny, you hear on the news, nobody talks about this. Everyone likes to talk about COVID and other stuff, but no one really talks about how disastrous our tax system has become. So Neal does a great job of exposing that and also giving useful tips to combat all these crazy problems in our tax system. So I highly recommend that you go buy the book. But aside from the book, again,
I do have another question, if I might. You
yeah,
mentioned in passing that CRA could, after the fact, say, "Oh, you really should have been doing installments." Like, I didn't make a whole lot of money last year at all. This year, I'm making more money. Now, I am a client of yours, so I'm assuming that at some point I'll get advice, around this.
Yeah,
But
yeah, yeah.
at what point do we have to say, you know what, we should be making installments?
Yeah, so the main thing you have to keep in mind, and this is just for you, not just for you, but
Right.
just everyone here in general, is that when your previous year you owed over $3,000, and this is like, so firstly, HST, if it's over $3,000 previous year, then you automatically have to start making a quarter of those installments into the following year. When you're talking about personal taxes, they give you additional years grace. They allow you to say, if it was $3,000 2 years ago and then $3,000 prior year, then this coming year you have to make installments equal to 1/4 of your taxes payable in that year. Okay. So
What
that's
if you
generally
didn't have tax payable last year, but this year's a
right.
big year? Yeah.
Right. Yeah. When it comes to the personal taxes too, we find that CRA is a bit better at giving notices. The thing that they do not do good, that again, I came across this myself with a surprise this year, was HST, and they're saying you owe installment interest for whatever. I'm like, what the heck? And then it's sure enough, because my HST liability was over $3,000. So, so my learning lesson, and I'm teaching it to my clients now too, is yeah, I mean, if you see that it was over the 3,000 mark, you should be making installments to avoid just basically paying installment interest. I mean, not to say installment interest is a huge amount, but at the end of the day, it's free money to the government. Why pay it if you can avoid it?
Okay, well, I'm sure at some point we'll talk, offline about that.
Yeah, it's yeah, well, we have it in our
I
schedule.
took your advice, and I do have that separate savings account with HST
Good.
sitting there. So
Good.
Great.
thank you very much.
No problem.
Thanks,
Thank you
Chip.
all for
Thanks for
joining
coming.
us. Have a great day. And as I said, feel free to also add us or join us on our Facebook group, Tax Tips for Real Estate Agents, to get weekly tax tips.
That's great. Thank you.
Okay, take care, everybody.